Howdy, everybody. Welcome to Liberty Call. Today is Friday, March 8th, 2024. Hope you're having a fantastical day out there. We got snow here in Colorado. Not too much. It's not sticking to the pavement, but, it's still cold and gross and slippery outside. So, like I said, hope you're having a good day. If it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, like, share, subscribe, follow, and press that notification bell. Looks like the markets were not in a good mood today, and looks like the week is not going to finish off in the green for most of the big indexes here in the Americas. And I see a little more green across the globe. So, all right, well, let's go ahead and get into the numbers for today. Dow Jones was down 0.18%, 68 points, closed at 38,722. S&P 500 down 0.63%, closed at 5124. NASDAQ down 1.16%, closed at 16,185. The VIX was up 1.94% today. It's at 1472. Canada down 0.26. Brazil down 1.06. And Mexico down 0.24. In Europe, Germany was down 0.02. The UK down 0.43. France up 0.15. The Netherlands down 0.78. Spain down 0.13. Italy down 0.04. Switzerland up 0.62. And Portugal down 0.6. Russian exchange is both green today. The MOEX up 0.09, the RTSI up 0.02. And the Asian markets, the Nikkei was up 0.25%, Australia up 1.07%, New Zealand up 0.71. In China, the Shanghai was up 0.61%, the Shenzhen component up 1.1%, the China A50 down 0.14, DJ Shanghai up 0.59, Hang Seng up 0.76%, and the Taiwan weighted was closed. Been closed a lot recently. I'm not sure why. All righty. Well, let's go ahead and take a peek. Where is it? There it is. Take a look and see how the markets did for the week. Let's get this all right. Starting with the Dow Jones. Looks like it's going to finish the week down about 0.69%. The S&P 500. Let's zoom in there. It's going to finish the week off down about 0.1 maybe. The NASDAQ composite finishing the week off down about 1%. And the Dow transports, where's the fourth? There it is going to finish the week off down about 0.78. And the Dow utilities, looks like this is the only one that's going to finish in the green, up almost 3%, 2.94%. So that is the markets for the week. So again, everyone's on pins and needles with Powell's testimony and the data coming out this week. We're going to get into some of the jobs reports here later on and go through those numbers. While they look good, you dig a little under the surface and it's not that fantastic. All right. Let's get to the economic data this week. Start now with jobless claims. Initial claims came in at 217,000, right on forecast, same as last week. Continuing claims ticked up to 1.906 million. Forecast was 1.889 million. And the previous number was 1.898. So it went up just a smidge there. Total vehicle sales came in at 15.81 million. Forecast was 14.92. And if we look at this chart, vehicle sales have been fairly stable here in the last couple of months, haven't dropped dramatically. And again, if we zoom out to the bigger chart, other than the downturn we had in 2020, it's been fairly stable. I mean, it certainly is not as high as it was in 16, 17, and 18, but not terrible. U.S. factory orders month over month contracted at 3.6%. We were expecting a contraction of 3.1. Last month's number was a contraction of 0.3. The ISM non-manufacturing purchasing managers index came in at 52.6. Forecast was 53, so just a smidge under forecast. Last month's number was a 53.4. The ADP non-farm employment change grew by 140,000. Forecast was 149. Previous number was 111,000. The job openings and labor turnover survey showed that there are 8.863 million jobs open right now. Forecast was 8.8. Last month's number was 8.889 million. So down just a smidge. You can see here since it peaked out at May of 22. Let's see if the chart gets any bigger. Yeah, May of 22 was the peak of the JOLTs report, and it's kind of stabilized here in recent months. Really slowing down. The U.S. trade balance, the trade deficit came in at negative $67.4 billion. Forecast was negative $63.4 billion, so $4 billion over the forecast. And I'm sorry, that's probably trillion. And the previous number was negative 64.2. The Nonfarm Payrolls report came in today at 275,000. Forecast was 198,000. Previous number was 229. And the unemployment rate increased up to 3.9% this month. The forecast was 3.7, and that's what it was last month. And the participation rate did not change. It's still at 62.5, and that was the previous number. So I'm not quite sure if the participation rate didn't change. Why did the unemployment rate tick up 0.2%? So that is a little odd. And all right, that's all the data there for the week. So let's move on over to the market recap for the day. U.S. stocks fall on mixed jobs report, nosedive in Nvidia. All right, on Friday, U.S. stocks experienced a decline primarily attributed to a slump in Nvidia and a mixed labor market report. While the report indicated that more jobs were created in February, the unemployment rate unexpectedly ticked up as layoffs accelerated. Non-farm payrolls rose by 275,000 in February, surpassing economists' expectations of 198,000, reflecting the improvement from January's figures. However, the uptick in job creation tempered wage growth, contributing to the unexpected increase in the unemployment rate. The conflicting signals from the labor market report have left analysts divided on the Federal Reserve's next move regarding interest rates. Jeffrey suggests that while the job growth suggests the Fed should remain in its current stance, other indicators like wage and household data hint at a potential rate cut in the near future. The mixed jobs report precedes an upcoming week filled with a significant economic data, including consumer inflation figures expected to show another notable increase. UBS maintains its forecast of 3 rate cuts this year in 2024, with June earmarked as a potential date for its first cut, contingent on softening economic data. In corporate news, Costco witnessed a 7% drop in its stock after reporting quarterly revenue below expectations, attributed to reduced demand for higher-priced items and the absence of a membership fee hike. Conversely, Gap saw a 3% increase following a fourth quarter beat, fueled by strong demand for its Old Navy and namesake brands during the holiday season. The semiconductor sector also experienced fluctuations, with Broadcom falling nearly 2%, despite posting better than expected results, while Marvell Technology dropped almost 11% due to disappointing guidance. Despite the setback, Deutsche Bank views Marvell's weakness as a buying opportunity, citing accelerating AI trends that could bolster the company's earnings. Overall, the chip sector faced some cooling of AI-led optimism, evident in Nvidia's 6% decline from record highs. All right, so it's kind of a good news, bad news situation. You see Jake back here is just ecstatic with everything going on. All right, next up, I got the February employment report. This comes from First Trust. I'm just going to read through their summation here. It's not too long. All right, let me make that a little bigger for my old eyes. Another month with a solid headline gain in payrolls in February, but the details of the report show a murkier situation in the labor market, where not all is well. Non-farm payrolls rose 275,000 in February, beating the consensus expected 200,000, and revisions to prior months reduced payrolls by 167,000, bringing the net gain to a moderate 108,000. More important, net revisions, private payrolls rose only 19,000 in February. That's not a typo. There's not a zero missing from that number, 19,000. We like to follow payrolls excluding government because it's not the private sector. Education and health services because it rises for structural and demographic reasons and usually don't decline even in recessions. And leisure and hospitality, which is still recovering from COVID lockdowns. That core measure of payrolls rose a modest 80,000 in February. Meanwhile, civilian employment, an alternative measure of jobs that include small business startups, declined by 184,000. In the past, at economic turning points, the civilian employment figure has done a good job of picking up future weakness in payrolls. In the past year, full-time civilian employment is down, while part-time is up, another sign of impending economic weakness. Moreover, on account of the drop in civilian employment, the unemployment rate rose to 3.9% in February, the highest in more than 2 years, versus 3.7% in January. However, there is good news in the labor market as well. Total hours worked in the private sector increased by 0.4% in February, reversing the decline in January. Hours are up a moderate 1% from a year ago versus a year ago. The Federal Reserve will like that a 4.3% gain is slower than the 4.7% gain in the year ending February 2023. And workers will like the 4.3% gain is beating consumer prices, which are only up 3.1% from a year ago, assuming a 0.4% increase in prices in February. Our view remains that companies have gotten out over their skis in terms of hiring, a recipe for layoffs later in 2024. Total payrolls are up 1.8% in the past year, a pace that would be normal in the middle of an economic expansion when the unemployment rate and available workers is much higher than it is today. A weaker job market is heading our way. All right, so that's everything there from the guys at First Trust. They do a really good job of pouring through the data and giving you the non-BS way of looking. Oh, Jake, is it that sad that the economy is probably going into a recession? Poor guy. All right, next up, got an article here from Zero Hedge, what dollarization says about returning to the gold standard. And this comes via shiftgold.com. All right. Javier Milei, hailed as Argentina's libertarian president, has garnered attention for his vocal criticism of leftism, Marxism, and Argentina's economic woes. Notably, its soaring inflation exceeding 200%. We thought we had problems here. Surprisingly, despite his libertarian stance, Milei advocates for Argentina to adopt the U.S. dollar, a move known as dollarization. Dollarization, common in smaller nations relying on American trade or tourism, aids to stabilize economies and reduce transaction costs. In Argentina's case, Milei sees it as a solution to the peso's devaluation due to government overspending and inflation. Unofficial dollarization is already prevalent among Argentinians seeking stability. Milei's push for dollarization faces hurdles requiring substantial government spending cuts. However, it promises benefits like lower inflation and curbing fiscal irresponsibility. Hey, that's a good thing. For ordinary Americans grappling with soaring national debt and inflation amid government spending, Argentina's pursuit of dollarization underscores the challenges of fiat currency. The U.S., lacking an alternative large economy, shares global fiat currency struggles. Gold, with its intrinsic value and historical role as money, emerges as a potential solution. While a return to a gold standard seems plausible, it may follow a gradual trajectory akin to Argentina's informal adoption of gold as a store of value, signaling investment opportunities in precious metals. So, yeah, if we could get our currency back under control and stabilize it without printing and printing and printing, I know why the government does it, because it's harder to steal it from people like you and me than it is just to make more and then saddle us with debt later on. All right. And one more article here comes from Zero Hedge also, titled The Financial Crisis Begins. This comes from Jeffrey Tucker via his article in the Epoch Times. Jeffrey's another libertarian. If you haven't noticed, I tend to talk about them a lot. All right. In Jeffrey Tucker's analysis for the Epoch Times, he delves into the precarious state of the U.S. financial sector, which has so far been cushioned from crisis despite massive inflation fueled by extensive money printing. However, Tucker warns that the stability may not last for long. The commercial real estate market, particularly in major cities like New York, is a critical area of concern. The sudden shift to remote work during the lockdowns fundamentally altered office dynamics, prompting many companies to reevaluate their space needs. With leases expiring and demand shrinking, mortgage holders face dwindling revenue streams and struggle to service massive loans. New York Community Bank Corp, a key player in the New York City market, exemplifies this dilemma. Facing financial woes, the bank received a substantial bailout orchestrated by former Treasury Secretary Steven Mnuchin and major lenders. While the bailout temporarily stabilized the situation, credit rating downgrades suggest deeper systemic issues persist. Tucker argues that despite bailouts, the underlying problems in commercial real estate remain unresolved, particularly in major cities like Boston, New York, York, and Chicago. I'm not sure why anyone would want to go to those places. As weaknesses persist, centralized interventions and future bailouts are likely, but they merely delay an inevitable financial crisis. The Federal Reserve's inclination towards rate cuts, despite ongoing inflation, signals its readiness to prop up markets with increased money supply. I've been saying that and saying that and saying that. They're just waiting for something bad to happen, and then they open the printers and money comes flying out. This prolonged inflationary environment underscores the importance of assets like gold and Bitcoin as safe havens, driving them to new highs. Looking ahead, Tucker warns of a potential repeat of the 1970s with multiple inflationary waves looming on the horizon. He emphasizes that regardless of political outcomes, inflation remains a pressing issue rooted in responses to past crises and decades of loose credit. In essence, Tucker suggests that the U.S. is on a collision course with a financial crisis, with only the pathway to its unfolding yet to be determined. As the century of inflationary finance persists, the inevitability of a crisis becomes increasingly apparent. I agree with Jeffrey there. We cannot continue to, artificially manipulate the credit system, which we've been doing, going back to 2009. When we had the mortgage problems, and they kept the Fed kept interest rates down at zero until 2015-ish, somewhere in that range. So, we have the better part of a decade of built up inflation in the system, and then you add in the $5 trillion, $6 trillion that was printed in 2020 and 2021. Just amplified the problem. So, for those to say we didn't have any inflation prior to 2020. And the current administration that we have now, that's a lie. Obama was behind it, Trump was behind it, and Biden is behind it. And you could even go further back and say that the presidents Bush and Clinton and Bush before him didn't do anything to really help things by expanding the warfare state and all the problems that we have now. All right. Well, that is everything that I had for today. Went on a little long, had some extra articles I wanted to cover, but that's it for the week. If anyone needs anything from me, please go to, hang on a second, there it is, dsafinancialgroup.com. Isn't that amazing? You can, all my contact information is there. I hope you have a wonderful weekend, and I shall talk to you next time. Adios.